Welcome back to Macro Insight, guys. Today is the 9th of February, and let's take a look at markets. So markets have continued to charge higher. So we had the bounce on S&P off, what looked like relatively oversold levels in the short term, at least. We had reached the lower Bollingers. We had seen some bullish divergences, and we've got back to some confidence levels, right? So that was the previous Sunday. So had that bounce, as I had said, I had bought little scraps on the lows down there, and I was not in a rush to sell them. And gradually, as we made new all-time highs, that's when I started to let exposure go, basically. The reason why we've continued charging, main reason would be case counts on the virus have been dropping across the US and Europe. So that's good news. The US cases were down about 25% last week, which is like the largest drop since the whole pandemic has begun. So the market's taken that well. You've also got, the stimulus likely to come through. Yellen keeps calling for a big stimulus to get the US back to full employment. It seems like the Democrats are going to get, something over $1 trillion through. So that's supportive. You've had all of these factors kind of fueling inflation expectations. So, if you look at where inflation break-evens are, which are a market measure of inflation expectations, they're going higher. They're back to like 2013 levels. So, that's being taken as a sign that the reflation trade is on, basically. Also, you're seeing yield curve steepening as the front end of the curve is anchored by what guidance the Fed has given, that they're not going to raise rates till like gone 2023. So that keeps the 2-year anchored, and then the long end rates sell off, i.e. yields higher, bonds lower, and that makes the curves all steepen, basically. So that's all a sign that the market is comfortable that is the theme that's driving things at the moment. Yeah. What else? We had US earnings were strong. Some of those big tech names last week reported, probably the most notable one being Google, which was up 8%. So when you've got companies like Google with their market cap still managing to rally 8% on earnings, I mean, it tells you you're in a bull market still very much, right? A lot of people were arguing that Google was going to struggle with the whole people's advertising budgets being slashed and things like that, but it doesn't seem to matter, right? So the big driver of these FANG stocks and why they just keep beating and they just keep doing well is they're just so big in AI, right? And they're such market leaders in AI that they just pick up efficiencies, and that just improves their revenues and just generates more and more revenues, right? So it's basically the AI story that is driving it, and because they're so far ahead in that space than anyone else, like when I say they, I mean the Amazons and the Googles, they're so far ahead in that space that they're just able to just keep swallowing people up and just keep taking market share and just keep beating, basically, right? So you don't really want to step in front of that freight train, right? Okay, so that's kind of what I've been seeing in the news. In terms of, so let's look at some of the charts. So obviously the S&P, we're back up to this 3,900 level. Seems to have found a little bit of a pullback around here, but it's nothing too dramatic. I mean, I think we might pull back maybe to 3,850 before it kind of goes up again. But I've lightened up some of my longs just because we rallied so hard, so fast in like a week. But my intention would probably be to dip my toes back in and I'm talking about tactical longs. I've still got my longer term exposures that are in there. But in terms of my tactical sort of futures trading, I've taken my S&P longs off here, and I would probably buy some scraps again at around 38.50, because I do think over the coming month we are more likely to see 4,000, right? So, but I just like trading the swings a little bit, and that's what I'm kind of doing. Similar story on Nasdaq, kind of the identical chart, really. Not a lot to add there, other than if yields. And we'll have a look at the bond yields in a minute. But if yields do go higher, say we get a high inflation print this week. I think the inflation numbers are out on Wednesday. say we get a high inflation print in the US and that takes bond yields through the 120 level in 10-year, maybe tech will underperform on that basically, right? So generally the growth stocks and the tech stocks in a yield higher environment should probably not be the ones that are leading the charge, right? It should probably be the value sectors. So you're more likely to see the banks rally and maybe some of the Russell 2000 type names, and maybe they're going to rally because generally that's how it tends to work, right? So I'd say if you are bullish and you want to buy the market in the super short term and you think you're going to get high inflation prints, then probably tech isn't where you want to be using that capital basically. Yeah. So we've got DAX here, a little bit lagging this morning in Europe. I haven't seen particularly the news that makes Europe underperform, but often Europe just tends to be the first one to roll over, right? If things are a bit overextended, right? So I don't think it's anything particularly sinister, but you know, DAX got as high as 14.2. I mean, that's as high as it's been basically, right? So it did make a new high. But generally, I just think the European market is I'm not as excited to be long the European market. I'd rather be long US or Asia. Asia, I think, is just bulletproof right now, and we'll have a look at some of the Asia charts. But I don't think, if you're going to park money into equities, I don't particularly think you chase it in Europe, right? And we'll have a look at FTSE as well, as Parley wanted to. FTSE, I think, tends to be very, very dependent on what the pound is doing, right? So you look here, the FTSE, it has bounced as well, but you look at it, since the start of the year, it's kind of lagging, right? And that's just because of the pound strength, right? So if the pound is strong, the FTSE is going to lag, right? So a bullish view on FTSE needs to be coupled with a bearish view on the pound, right? So if you think the pound's overstretched and you fancy the pound to come back lower, then maybe FTSE is not a bad way to be in terms of owning equities, because that will get a kicker from the pound coming down. But, outside of that, the companies that the FTSE tends to be made up of, like some of the basic resources and energy stocks, you'd think they'd be doing relatively well, right? But you can see the FTSE is not outperforming. So the overriding factor for the FTSE is not the fact that it's in commodities, that it's got a reasonable high amount of commodity stocks in it. It's just that it's the pound driver is just keeping a lid on that basically, right? So if you want to play commodities, don't do it via being long the FTSE, I don't think, right? You do it via actually owning commodities and owning ETFs and stuff like that, okay? In terms of Asia, China's doing well. India is just crushing it, right? So Indian equities, I mean, I'm kicking myself. I wanted to buy that dip. I missed it because it was flipping closed when I tried to buy it, and then I forgot, and it's just run away, right? So, but this just does seem like the new long-term thing to be in, right? Some Asian markets, Asian markets have handled the pandemic better. They've not had to massively increase their debt in the way the US has. And they're in a good spot if you get more dollar weakness, basically, right? So it seems to be an overriding theme from a lot of the macro guys out there, a lot of the smart macro portfolio managers, who is basically saying EM equities, in particular Asian EM equities, is the place to be. So if you've got money to allocate into equity markets, definitely something you need to look at, right? Looking for any dips to buy in places like India, maybe a bit of China as well. I think China's kind of maybe run its course a little bit, especially if you look at some of the internet names in China. I mean, they've gone ballistic. But India, what else? Taiwan, I believe, even Korea, places like that. Japan's doing well as well. All those Asian stock markets are doing pretty well. So any dips in that space, I'd be allocating some long-term money into those things, right? Before we move on to any other asset class, as usual, we'll talk about the VIX. So have a look at the VIX. So, the VIX spiking sort of a week ago was also another signal where it felt that there was not massive complacency in the vol market. Vol was actually trading expensive. So you had VIX, the futures contracts in the VIX were above 30, right? Even as high as like 35, I think they got to. But whereas, you know, realize has been tracking in the teens. Yeah. So like you've got 30-day realize at 15.5, 10-day realize at 22, and you had the front month futures in VIX in the mid 30s, right? So vol was very pumped. And the way I took that was to say that if when the market was at the highs previously, so, you know, 10 days ago, whatever, you had VIX high versus realized. And so that to me is a signal that people are either long the market via call options, which we know that the retail army generally loves buying call options to express their bullishness because they get leverage to that view. So that gives you a bid for volatility. And then on top of that, the asset management and the real money community, who arguably is also long from extreme bullish sentiment indicators that you're getting across the board, cash levels being at record lows, you know, all the fund manager surveys and stuff suggesting that things are very bullish positioning wise. But those guys are not just naked long. They're long, but they've got puts to protect them, right? And that's what keeps a bid to volatility. So that's what keeps the VIX looking very, very expensive against realized volatility. And when you have that, even if you get pullbacks like we got on the Gamestop fiasco, it was likely that those pullbacks will be shallow because the market, as in the real money community, is well hedged and they don't need to panic. So it doesn't cascade into something too dramatic, basically. And that's what we saw, right? Because the VIX was already elevated, we sold off, VIX went even higher. It was looking very, very toppy. If you look at the Bollinger Bands on the VIX, it was like at the top Bollinger Bands, and it was giving you a signal that maybe this is a little bit overdone now, right? And then we did get the rally. So those are all things to kind of look out for as you see future corrections. You know, looking for those sort of telltale signs will help guide you to know how deep maybe this thing can be or how dramatic it can get, basically, right? When vol overshoots to the downside and it becomes really complacent and and no one thinks it's worth hedging anymore, that's when you know that a sell-off can turn into something more sinister. And that's what we saw in March last year. Vol was at pretty cheap levels. No one really thought any real sell-off was happening. Everyone was super bulled up in January. You're having parabolic upside moves in Apple, Tesla, things like that. Similar to what we've seen recently, but the difference is the vol environment. Here, the vol environment is showing you that actually vol isn't complacent, whereas a year ago, vol was a lot more complacent, basically, right? So that's why maybe this quarter could actually be quite a bullish one. And even though you're starting to see signs that things are looking frothy, it could have some legs to run because people are doing it in a hedged manner, right? So something to think about there. Because I think the reason why the VIX has stayed relatively elevated is because a lot of the supply got taken out, because a lot of the vol sellers got hurt last year, right? But I think, I think that's gradually going to start coming back. Maybe not in the same size or whatever, but I think at some point this low realized is going to drive that VIX through 20. I mean, I don't think it's going to go straight back down to those lows of like 12, right? But I think a move from around 21, 22, where we are now, down to around 18, I think is quite realistic over the coming month or two as this sort of bullishness reaches a bit of a crescendo, yeah? And then I'd be thinking once we get down there to start putting some bearish bets on, basically, right? Where I'd say vol's got cheap enough, there's the vaccine stories kind of played out, and the market's maybe got to 4,000 or whatever on the S&P, and then I think it'd probably set up as quite a nice short. But right now, I'm not really doing that. I'm not really putting on any shorts on in equities. I'm kind of staying out of the way of the rally. I tried to take a tactical short on oil recently, got stopped out quite quick, but I'm not really fighting the rally too much, right? So that's vol, and yeah. So on the other GameStop stuff, so all those meme stocks, right? BlackBerry, GameStop, AMC, and stuff. They came back down to earth, right? Like last week in a big way, yeah. So I think some people would have got burnt there. Some of the retail traders would have got burnt, and I think that something. I was watching an interview with Mark Cuban, and it's interesting. It's like he was arguing that the stimulus checks that the retail guys have all been getting is a good thing, right? Because then they go and spend their money in the way they see fit. And that kind of, rather than the government raising taxes and kind of deciding how to spend it and doing all these big government programs to manage the economy, right? He thought his more efficient way is to just give the guys money, free money, like stimulus checks, and let the market, let the people decide how they want to spend it. So they're gonna either consume goods and services that they want to consume, and that will benefit the companies that provide those goods and services, right? Or they're going to invest in companies that there's growth potential in and all that stuff, right? So in theory, that's a really nice concept, that that's an efficient market where the people decide where that capital should be allocated, right? So you give the people the capital, and then the capital finds its way into where it needs to go, right? Into the industries and the economy. But the problem is, like, with the speculative activity that's going on in markets, because no one can go out and do anything, there's this whole Robin Hood culture that's come up, has meant that people are chasing like just stocks that they think they can flip, right? And they can make, now short squeezes have become fashionable and stuff like that. So I'm not sure it's a productive use of capital, right? Because they're not investing in companies that they believe in. They're investing in companies that they think are going to short squeeze, and they're companies that they know are rubbish companies and are probably going to go bankrupt at some point, right? So I would say, in theory, it's a nice idea that that's the way capital finds its way in the right places. But in practice, the way the market's trading and the way people are acting in the retail space, I don't think that's the case right now. I think it's quite dangerous. I think the speculative activity, is diverting capital away from the real economy, and it's just going into stock markets, basically. And it's not necessarily going into names that deserve that money, basically, right? So, AMC, I think, was able to raise a load of capital just because they ramped the stock price up 3x that week, basically. And they came to the market and raised a load of capital. So, maybe that, they bailed out AMC, but I don't know. I'm not sure. I'm not sure it's the right dynamic, personally. Right. And then another interesting guy to listen to is Stan Druckenmiller. And he just summarized beautifully the world we're in, right? So he said, we had the worst, deepest recession since World War II, which was 5 times worse than any previous recession we'd seen in that time, okay? But it lasted only 25% of the time, right? We came out of it in a quarter of the time that we normally take, okay? And then, so that's one sort of, in a nutshell, way to describe what we've just been through. In response to that recession, we've had the Fed buy more bonds in 3 months than they did in 10 years of previous QE, okay? The government deficit increased in 3 months by more than all those previous recessions combined, okay? 11 million people were made unemployed, but we had the largest increase in personal income in 20 years, right? It's just ridiculous, right? You've got literally 11 million people are still unemployed from the shock, yet personal income in the US, like 20% of all personal income last year in the US came from government stimulus checks, right? So we've got this really, really strange world that we're living in, where they've seen the size of the shock and they've just thrown endless money at it, basically, and they think they've got away with it. Right now, who knows if they've got away with it or not, but that's kind of what happened. And then the last point was corporate borrowing went up by about 400-500 billion or something in last year, whereas normally in recessions corporate borrowing gets hit, right? So in the financial crisis, corporate borrowing got hit by about a similar amount, so it increased by that amount last year, right? So it's just very, very topsy-turvy world we're living in, which does make it hard to rationalize some of this stuff, right? But ultimately, all that's happening is asset prices are inflating, and you've just got to know that, and you've got to accept that. And even Stan Druckenmiller, 30, 40-year veteran macro guy, is like, I'm pretty much long commodities, short the dollar, got a little bit of Bitcoin, short treasuries, right? So he's got the reflation trade on. He knows the reflation trade is consensus, yet he's got it on, and he's got it on in size, basically, right? So that's kind of what's going on, right? And the dollar pulling back. We'll talk about FX now, but the dollar pulling back. If we bring up the dollar chart, has kind of given that reflation trade, kind of restarted that chat about the reflation trade, right? So here's a chart on the dollar. Got as high as 91.5. Now it's pulling back. Reasonable pullback, done about 1%. It's back to the average there. This is kind of where it needs to hold. If the dollar rally is still ongoing, and we're going to get to 92, which it was looking like we were going to me, then I think it kind of needs to hold here, right? Because if it doesn't manage to hold here, then it's very, very likely to take out 90s, and then we just go straight back to the lows and probably take out the lows, right? So, and then that whole reflation, I think people are quite quick to jump on the reflation trade, right? Because even in the commodities, right? Commodities, despite the dollar bouncing, commodities were charging higher. Look at where oil is, look at where the ags are and stuff. So I think that is definitely the path of least resistance at the moment. So one to watch. But the dollar trade, I mean, I'm still short a bit of cable, as I have been forever. Keeps coming back towards this 138 area, keeps trying to take it out. I mean, I think if it takes out 138.5, then I'm going to cut my position in half, right? Because I think, and then I'll resell it again at 140. So I think there's a good chance that if it breaks 138.5, it probably has a run to 140 quite quickly. So I'm just going to opportunistically use that to kind of resell at higher levels. Like I say, I'm selling pound because I want to sell pound to diversify out of pounds. But as a day trade, or not a day trade, as a tactical trade, clearly it hasn't worked so far. You know, it tried to break that 136, but it didn't manage to stay down there that day, and it reversed very quickly to the top end of the range. Like I say, I'm not a fan of the UK. I think the UK is going to struggle. Why it keep rallying? Maybe it just keep rallying because a lot of people are short it, right? I'm not really sure. At the margin, I think the Bank of England didn't really talk up the negative interest rates idea as much as the market was kind of anticipating. So I think that is what kind of led to that recovery last week, where they're saying, you know, they're not planning on doing negative interest rates or whatever, but remains to be seen. I think, you know, confronted with poor macro data over the next 6 months, then maybe they'll change their tune, right? But like I say, I'm not going to be too stubborn with it. I'm going to probably trim it at above 138.5 if that happens. Right? This seems to be like the top of the channel at the moment, so could well take a stand here. In terms of euro, you know, as usual, it's the flip side of the DXY, back towards the average there. 122 is going to equate to kind of the low end of the DXY. I don't really see euro breaking out to 125. In terms of trades to get short dollar, my favorite is probably Aussie. So if you look at Aussie, the good thing about Aussie is not only do you get short dollar if you go long Aussie dollar, you get commodity exposure because commodity currency, and you also get some exposure to China growth. So if you think China growth is in a better place than US, you think the dollar bearishness is going to continue, and you want a bit of commodity exposure as well. This kind of has all of those, right? So I think there's definitely a chance over the next 3 to 6 months this thing keeps charging through 0.8. So I've been buying longer dated calls in this stuff because they're only on they're on like a 9 or low 9s vol. So you can get reasonable leverage to like a longer term view on Aussie dollar. I think the odds of that are quite decent. The thing about FX rates is that their day-to-day realized is very low, but they trend, right? So actually trading longer dated options in FX to express your view is a very, very efficient way to trade FX, because if you get the trend right, you're kind of getting a really cheap leverage play on that trend, because you know that the day-to-day realize is going to be quite low, and so the vol market factors that in, right? But for you don't really care about the day-to-day realize because you're just running the delta for that trend, right? And your option that you pay 50 pips for can turn into 250 pips, and then you get rid of it, right? So it's quite a nice way to play the directional trends that you identify in FX, doing it via 3 to 6 month naked options, right? If you look at the 10-year, so 10 years popped obviously quite quickly in early Jan. Then it had a bit of a retracement, held on to that 1% level, and now it's back to those highs, right? Certainly that sort of price action looks like it wants to take out those highs and probably get towards that 140, 150 area, okay? Really just a question of how quickly it's going to do it. The CPI print today is going to be interesting. Not today, I think it's tomorrow. CPI print is going to be interesting. I would suspect most people are expecting that CPI print to be a high print though, right? So So it might be a high hurdle to beat in terms of that specific data point, in which case you might actually see a pullback in all of these reflation trades, and it'll give you an opportunity to get back into them. Yeah. But if you think the kind of trend is for inflation to tick higher, whether it beats today's exact consensus expectation or not, if that is the trend that you're expecting over the coming months, which I think kind of is for most people, then you'd use any dips in the reflation trade to get into those, right? So dips in reflation trade would be things like bonds having a rally, you'd be a seller. Commodities having a dip, you'd be a buyer. You know, even dollar having a rally, maybe you'd sell into, right? Those are going to be the reflation trades that are going to happen if you get a low CPI. Okay. Talking about junk bonds, these two ETFs, HYG and JNK, are the ones I tend to look at. I mean, they're at local highs, right? So that just means that full bullish risk on sentiment in the credit market. The thing about the credit market is I don't really take it much of a price signal anymore, because it's just manipulated by the Fed, right? So when the Fed are intervening in corporate bond markets, it takes the price discovery out, really, right? In my opinion. So I don't read too much into what credit markets are doing these days, because of that factor. Yeah, I just think they've just swamped that market too much now, and so you know it can't really go down that much. Yeah. So that's bonds. And if we move on to everyone's favorite commodities, gold and silver. So this gold, I mean, I'm still thinking on this gold move, it looks corrective, right? It doesn't look to me necessarily that we're starting a new up leg, right? That's certainly not confirmed yet. If I look at the move down to the recent low, I've got a couple of sell levels that are coming up, one at 1850-ish and one at sort of 1865 to 70-ish. Those would be places where I'd consider putting tactical shorts on gold, if that's the way you're inclined. That's kind of how I'm thinking on gold. I think if the yields go higher to 150, I think gold's going to really struggle, and gold probably then will turn south again. Yeah. Now, what I would say though is like silver. So here you look at the silver chart. It obviously had its crazy move up, retraced that, and now it's trading quite nicely, and it's doing gold times 2 or whatever it likes to do. That chart does look a bit more healthy than gold. Like I say, the difference with silver is it's got a bit more of the reflation trade in it, because the industrial component, right? The industrial uses of silver. So if you've got economic recovery fueling this rally, then that does benefit silver more than it benefits gold, right? So you've got that at play. Now, I did put on some cheeky call spreads in March and some call flies in February to participate in the silver rally when the Reddit guys started getting involved. Now, those are doing okay. I didn't dump them because I wanted to see if this level would hold at 26, and it kind of did. If 26 goes again to the downside, then I'll probably just bail out on those call spreads, right? And probably get 2/3 of my money back, something like that. But for now, I don't mind running those call spreads, because what I may do is in a popping gold, if a popping gold happens over the next week, then I can sell some gold against these call spreads. And then I get into that spread, right? And that spread is something that I actually think might have some legs, right? So if you look at the spread between gold and silver, so this is we were talking about last week, like a beta weighted spread between gold and silver. So this is silver. So this is notionally adjusted silver versus short 3 times gold, basically. Okay. And this is what that price has done. So you can see it was trading, this ratio or whatever was trading at 0.3. It had a massive pop on the Reddit stuff, and then it retraced about half of that. And now it's been trading up quite well. Now, ideally, I'd quite like it to get back towards this average at around 31.5, at which point, if it was there, then I'd be quite happy to stick the short on gold against my silver call spreads. And then I'll effectively be getting into this spread at that sort of level, basically, right? So you look at the sort of trend on this ratio, it's been in recovery mode pretty much since that March sell-off, right? So this ratio has been kind of charging higher. So it shows you there's been some silver is outperforming its beta relative to gold.
Thanks so much for watching, guys. If you enjoyed this video, then we'd love to have you join our Macro Insight community. Just visit www.options-insight.com and sign up for your free trial to our live and interactive weekly macro call. If you haven't already done so, please subscribe to our YouTube channel. You'll find more market updates, class highlights from our Summer Academy, and also video tutorials on anything from options basics to market making fundamentals. You can also connect with me directly. I'm on LinkedIn, Twitter, Facebook, Instagram. You can follow me on any of those platforms. Or alternatively, feel free to send an email to inquiries@options-insight.com. Thanks a lot.